Only thing constant is change, and same is for financial markets also. So as Indian markets grow, as Indian economy grow, there are some changes which we have to be on top of it. One of the same change is development of passive strategy for investment. So what is passive strategy and how does it differ from active investment strategy? To discuss the same, we have today with us Sandeep Chhabria, who is the head of growth and development for passive strategy at HDFC Mutual Fund. Welcome Sandeep, welcome to our episode.
Thank you, Ankit.
So Sandeep, to start with very basic question, what is the difference between active and passive investment strategy?
So, as the name suggests, active a fund manager is there who has to take calls on what stock picking that he has to do. He has to keep in mind the underlying benchmark, his style of investment, the current market conditions, and even the macroeconomic factors and the growth prospects of companies, and then he selects and constructs a portfolio. And his return is judged with the benchmark, whatever is the benchmark, and his performance is judged with that. Now, in a passive fund, there is a fund manager, but his job is not to identify and see which are the stocks which will do better than the underlying benchmark. His job is to replicate the index. So, the index can be a very simple index like the Nifty 50 or the Sensex or Next 50, Nifty 100, or maybe a mid cap 150 index or a small cap 250 index. The job of this fund manager is to replicate the returns of this index, and whatever is the difference between the returns of the index and this fund will be known as the tracking difference or tracking error, as we say, because there will be some expense associated with running the fund and doing transactions. So to that extent, he will not be able to replicate exactly the index returns, and those returns are also benchmark the TRI index, whatever is there. However close he is to it, the more efficient the fund manager is. So this is a passive style where there is no choice given to fund manager. So that is the basic difference between active and passive.
So I can say if I'm a fund manager and I run a actively managed mutual fund, then
Yes.
my job is to pick up the stocks
Correct.
and put them into the mutual fund.
Yes.
But if I run a passive investment strategy, then I just need to identify which benchmark I will follow.
Correct.
And whatever will be benchmark returns minus some error, minus some margin of that will be my fund returns.
Correct.
Okay. So, Sandeep, if you can take us through some pros and cons of both strategy, what are the benefits of investing in active, what are the benefits of investing into passive? If you can take us through for, let's say, for a general retail kind of client, HNI
Yes.
kind of client.
Correct. So in India, the current market situation is that active is a very large part on the equity side, or a very large part of the allocation which happens into domestic equities, and passive is something which has grown recently in the last 9 to 10 years that it has picked up. Still, it is around 17-18% of the industry AUM. And the advantage of active is that if the fund manager is able to generate significant alpha over his or her underlying benchmark, then you tend to benefit from the positive performance of the fund manager. Similarly, when the market is in a corrective mode, or it is consolidation phase where the returns are not being generated, if he is done better, still capable of generating alpha, then he has done his job. So the active fund management is by far more popular in India, and any investor who is considering investing in the stock market for the first time, it would be better to come through the mutual fund route. And as we have seen in the last 5 to 7 years, that SIP mode of investing has become very popular. So you can register for a simple SIP in an actively managed fund, and you are sorted. Because if you see the track record of most of the older funds in the industry which have been around for 15, 20, 30 years, we have many funds at HDFC Mutual Fund which have got a track record of 25, 30 years. They have generated significant alpha over the underlying benchmark. So then you benefit from that. You are beating inflation very comfortably. There is a scope for wealth creation. For the longer time that you invest, you are able to create wealth. And that can take care of your long-term goals, whatever financial needs which you may have been planning for some time. You can, through that wealth creation, address that need. Now, passive funds, I'll tell you the genesis very briefly. They started in America. There was one person called John Bogle. He started the Vanguard Fund. Actually, previously he used to also work in an active fund house. Then there were a lot of studies by these Nobel Prize winner economists where they spoke about the total market return or efficient market theory. A lot.
Information arbitrage.
Yeah, so all these concepts are discussed, and they came to the conclusion in America, that is, that it is difficult to meet the market consistently over time. So if you can't beat the market, at least capture the market return. So from there, the seed or thought of index funds or passive funds started. And they went through various permutations and combinations where they tried to replicate this return, but they found it difficult because there would be impact costs of buying every stock, selling every stock. They would not get, like, in proportion the quantity, the stocks that they wanted, which form part of the index. And then they actually graduated to market cap weighted index, way of buying the index as a whole, and that's what became popular, where the free float market cap was considered, and that gave the rise to the index fund. And from then on, the passive story grew not only in equity, in fixed income, in other asset classes, across geographies other than America, what they call as emerging markets, developed markets. So that kind of universe there kept expanding. So if you see in the Indian context, the passive products became popular when retirement funds like Employee Provident Fund, they got a mandate to invest, start with 5% of the corpus to go in equity. This was
Incremental money.
yeah. So this was in 2015, and then from there it went from 5 to 15% is the maximum, but realistically most are at 10%. And this is because the interest rates in India are like other, as you develop as an economy, the interest rates tend to come down. The same thing has happened in India as well, where the interest rates are gradually coming off. And the retirement funds used to have mostly a bond portfolio, so the yield used to take care of whatever the payouts which are needed for someone's retirement and all those kind of or someone's pension, all those kind of things were there. So the government introduced this because they were facing a shortfall in terms of the returns, because as the old bonds were maturing, new bonds were being issued at a lower coupon or lower yields. So that's why this equity investing started. So a lot of the ETF equity money in India is from the EPFO and other exempt provident funds. And in the retail space, the equity index funds, which are just like mutual fund in terms of structure, that you buy and sell from the AMC directly, and you do it at a lower cost than the active products. So if you are, there are a plethora of mutual funds. There are 40 odd, 45 odd asset management companies, and they have 50, 60 schemes each. So you are running into thousands of schemes, and to select which scheme would suit your risk appetite, your investment style, or your expectation of return may become challenging. So you can look at index funds that India's story is good, the GDP is growing, the corporates are doing well, so the market will also go up. So at least I should capture the market return. So equity index funds in last 3 years have become very popular. And if you see the trend that the sales are continuing to increase in equity index funds, both via lump sum and via SIP. So that is where it is at here. And a lot of sophisticated investors, what they do is some percentage of their equity portfolio, around 10-15%, they want to put in a passive product. Because generally what is happening is that a lot of this concept of family offices has started in India, where they are selling off some big chunk of their business and they are realizing that cash, and then they are happy with the index return. They don't want to again take a risk and create alpha, because if you then purely put everything in active, then it may underperform. So they have already taken the business risk. They don't want to take it again. So some percentage of their portfolio, they want to say that, okay, I'll capture the next 10 years return for what is the India's potential in a passive product, and it is at a low cost, and I can take a exit anytime I want.
So what you are trying to say कि those segments of the market which want more certainty in their returns,
Yes.
like say EPFO,
Yes.
who doesn't want to have a higher sense of volatility in the portfolio, and family offices which have sold off their holdings and they want to have a more stable, less volatile kind of returns, they prefer passive over investment, at least for some part of their portfolio.
Yeah, because they have taken the risk over time, it has paid off. They have realized some gain, which is a substantial gain in terms of their overall kitty. So they feel that they don't want to again, put that entire money at very high risk. Some portion of it they can allocate to passive, though the risk is there in passive also because it's an equity investment at the end of the day, but you only have market risk. You don't have a fund manager risk where...
So what they call systematic and unsystematic risk.
Correct. So what is happening is that ever since smartphones, digital apps, and the growth of all this Grow, Zerodha, and other aggregators which are the online space, everybody has got access to information on their mobile phones. Previously, maybe the information which a fund manager we used to get after 1 month, 2 months, 15 days. Now it's a matter of minutes. Maybe what he comes to know, I'll come to know after half an hour, 45 minutes, 1 hour. So that information edge is coming off.
And information arbitrage is coming down.
So, and it is so fast because of all the algorithms that it does not last that long. So that is why they feel that an index fund or a ETF could capture these market returns very efficiently.
So Sandeep, some of the biases that we read in finance, one of the biases is herd mentality.
Yeah.
So for last 2 years, everybody has been putting money into small cap and mid cap because they are seeing that markets have given, these
Correct.
segments have given high returns, so I will
Yes.
also get high returns.
Yeah.
And why I am asking you this question is because you mentioned that there are segments for which it makes more sense to be in passive
Right.
for a substantial part of their portfolio.
Right.
So is it correct to say that whether passive makes sense for me or not is very unique as compared to whether it makes sense for somebody else or not?
Yeah, so I think it differs from person to
Yes.
person. It is not a one size fits all solution. I agree with that thought. And passive products have become popular more on the large cap side, where the information arbitrage is very less.
Very less.
So in that top 100 stocks, to generate alpha for the fund manager within that framework, that he has only that universe of those 100 stocks to pick from, it becomes very challenging. So that's where the other next 50 or these Nifty 50 or Nifty 100, those become popular. And but in small cap and mid cap, we've seen a lot of fund managers have generated alpha in the past. But what we are seeing now is that a lot of the very successful funds have grown a lot in size. And then the universe also for mid cap is amongst 150 stocks. Then it becomes challenging over time to keep generating the alpha. So maybe a nascent trend which has started in last 1 or 2 years is that small cap and mid cap index funds have also started gaining
Traction.
popularity, or the Nifty 500 type of, which is like a all cap index, or BSE 500, which covers mostly the entire market. Those also have started becoming popular. Just like in US, S&P 500 is one of the biggest indexes which has followed globally on the passive side as well, and even for benchmarking purposes. So those are kind of gaining traction in India. In last couple of years, we've seen a lot change there.
So 2 points to make over here. At Wealthy Nivesh, we follow 2 things that you said. One is that we look at universe in 3 segments: large
Yeah.
cap, mid cap, and small cap.
Yes.
And that's how we implement multi-cap at portfolio level.
Yes.
So instead of going for multi-cap mutual funds, we have multi-cap at portfolio level.
Right.
Second, as you rightly said, ki higher the fund size, then propensity of generating higher returns keeps on coming down.
Yes.
So this was one insight which was shared by our research mentor Professor Vikas Agarwal. Ki it keeps on happening in America. Ki when active fund managers fund size becomes large, the returns keep on coming down. And when we saw it in Indian context, it was so.
Correct.
Except for some outliers, generally
Yes.
the trend was ki higher the AUM, the lower will be propensity to generate higher returns. Now my next question to you is कि there is one plain vanilla passive kind of a strategy where you are like कि ये NSC है, NSC को मैंने पूरा का पूरा replicate कर दिया.
जी.
Over and about that, now we are getting more fancier kind of passive strategy
Yeah.
where there is talk about momentum,
Yeah.
there is talk about smart beta. So can you take us through those kind of strategies, how they work?
So in last 3 to 4 years during this COVID time, there are a lot of these smart beta or factor-based indexes which were introduced by NSE and BSE. So they are looking at a factor or a rule-based strategy. That means the index is based on a rule, and basis that rule, the stocks are shortlisted in that index. And once that is constructed, then the what you call investor will then invest in that particular index. So the most popular strategies which are there globally also, one is momentum strategy, which is looking at the positive price momentum of the share. So whichever share is doing well in the recent past, those get shortlisted. Of course, there are factors like standard deviation which come into force. They look at the 6-month and 12-month return, and they come at some momentum score. So wherever the momentum score is the highest, they'll take a universe like, let's say, which is the most popular momentum strategy in India is the Nifty 200 Momentum 30 Index. So out of these 200 stocks, 30 stocks will be shortlisted based on this positive price momentum and adjusted for the risk. And then these 30 stocks are shortlisted. So globally and even backtesting data wise, these products have proven to be very good, but they also go through ups and downs just like any of the other active products. But these things are becoming popular in India. Momentum, low volatility is another strategy where you select, the 30 least what you call volatile stocks which have the lowest standard deviation from amongst 100, and then you invest in those stocks. So what people are looking at is that these are solutions which are somewhere between active and passive, and there is a scope of creating an alpha over the normal plain vanilla market cap weighted indices. So even globally these are very popular. There's another strategy called equal weight, that you equally allocate to Nifty 50 stocks or Nifty 100 stocks. These have also become popular. When markets do well, then equal weight strategies do well. Where there's a broad based rally, then equal weight strategies do well. When market is consolidating or in a bearish phase or only some stocks are doing well, then the market cap weighted strategies do better, where they say the market is polarized, for example. That's when these Nifty 50s may do better than the Nifty 50 equal weight. So there are horses for courses. You can do a SIP in momentum on a time like this because the momentum has clearly come off, so momentum stocks are not doing well. So it's the best time to do a SIP. You can do that. Or if you want to do lump sum, you do in a low volatility index where the market is moving up and down very sharply. This particular index will fall lower than the market. That's the premise. But upside, it will match the market returns. So these are customized solutions. There are a lot of customizations which are happening. A lot of these indexes are being tried out. We have to see which ones will emerge as the winners, which one will be the truly large strategies which are able to do well in different market cycles. Right now, because they have a very recent history of actual, operation, so they have not been in a phase where markets are correcting for 2-3 years. So that cycles need to be seen to understand, because sometimes backtested data does not pan out as the real data actually does. But this is something which investors, advisors like yourself, they are looking at very closely, and we are seeing that a lot of interest is there, money is flowing into them. And this is of course one of the let's say one step ahead of the market cap weighted indexes.
So, typically speaking, what happens when it comes about active and passive, it becomes more of active versus passive.
Yes.
People are either proactive or pro passive, and they are exclusive to each other.
Yes, yes.
In fact, some people claim that they have got a negative correlation to each other.
Right.
So, what are your views about the same?
I don't think one needs to have such strong views, because at the end of the day, I want my portfolio return to be generated. If I have targeted a return of 15 to 18% over 10 years, and anybody nowadays you have that rule of 72, so in how many years your money will double. And if you keep a realistic goal, you have to have both. In India, active funds is much larger in size. There are a lot of funds with very good established track record, and there's no reason why an investor should not choose active funds just because he feels that passives will do better in the future than active. So the best strategy would be to have a judicious mix of both active and passive. I think the other advantage in passive is that you can do it across asset classes also, like gold and silver ETF. I would like to bring to your attention, post this budget, the long term capital gains is at par with equity of 12.5%. And sovereign gold bonds have stopped being issued by the government of India, wherein if you are willing to be locked in, your gains would be tax free. But now that is not there. So gold ETF is a very good solution. If like people invest in a multi-asset fund, you can have equity investment plus gold plus fixed income. So all these kind of options are available in passive. So what one can do is that you have a core portfolio, which will be 60 to 70% of your equity portfolio, and a satellite portfolio of between It's your comfort level between 5 to 20, 25%, whatever it is, you can look at passive products. So you could have a smart beta factor based exposure, and then you could have some market cap weighted exposure of whatever indices you like. Nowadays, in like HDFC, we did two, a multi cap index also and a large and mid cap index also. So you have diversified indexes also which are available on the passive side. So you can do a judicious mix, but I think in today's context, just being only passive or only active would not be the right way. One should have a mix of both. And today the tilt would be more towards active because they have a more, established, longer track record. And basis the experience, one can then increase the allocation to passive. So passive has one advantage over active is that if you have a view on the market, if you feel today Nifty is at 24,000 and you are comfortable with the valuations and you feel that if there's a correction tomorrow of 5% and you want to invest in the market, then when that correction happens, you can put in that index fund because you know that what level you are getting into. The active fund may not fall in line with the market. So you may, invest when market is down 5%, but that active fund may be down only 2-3%. So passive funds help you take a view based investment strategy, and even for sector indices, whether if you're positive, let's say on IT sector or pharma sector, which
You can
everyone
take
is
a call.
positive because it's a bit defensive because the domestic growth is kind of slowing down slightly now. So you have got pharma index funds and ETFs, IT index funds, ETFs. So you can take a view on that. Or in the past, the window is still there, but RBI doesn't allow more investments in the overseas ETF and index funds. If you're positive on Nasdaq, you can go and buy the Nasdaq ETF. So this can form part of that 15-20% what I was referring to. So having best of both worlds, I think, is the right way to go. It is active and passive, not active versus passive.
So one can say कि at least in those asset classes where there is no active management.
Correct.
Let's say कि if you want to have exposure to bullion, to
Yes.
gold and silver,
Yes.
it makes sense to go over there.
Yes.
And if you have to take exposure to some abroad market which is where information arbitrage is very low,
Yes.
and ETFs are giving better returns, so why would you go in managed funds over there? Probably for that kind of avenues also you can take exposure
Correct.
through passive strategy.
Yes.
So Sandeep, let's take three market scenarios.
Yeah.
One is range bound, the other is bullish, the third one is bearish. So how do active and passive plays out in these three scenarios?
So in a bullish market, both active and passive do well. There's if the bull market is fairly long, like it was in the past, if it lasts for 3-4 years, then maybe the passive might even outperform the active because they will not be able to keep up with the upside capture. In a bearish market or a consolidating market, I feel active funds have the edge because they can select stocks which will not fall as much as the market. They can also have the liberty to take some cash position
Some derivatives also.
and some derivatives also, so they can cushion their downside risk. And by protecting the wealth or whatever gain they have made that far, by protecting the downside, then they can create the alpha for the investor. So typically, like if the market is falling, then the index has to, the fund manager has to keep buying the index. He is not going to protect you from any downside. So there, a active fund will have an edge. But if you are looking at it from a long-term investing, every fall in a passive fund, if the market has only fallen 5%, you have a great opportunity to buy the market 5% cheaper, 10% cheaper. If you still believe in the story that India is going to do well, per capita GDP is at $2,800, goes to $4,500. Other countries in this journey have done very well on the economic side, and then because of which even the stock market returns have done well because the corporate profits go up commensurately. So I mean, it is, as I said, that if you are, I think active funds are more designed for holding, buying and holding. And you can take, shorter positions in a passive product that you invest when the market has corrected. And suppose you feel the market has had a runaway rally, you can easily book those profits also. So you have to use it, judiciously what you want to do. That's, I think, that's how they differ.
So Sandeep, if I am a first time investor
Yes.
and I think that passive makes sense for me,
Yes.
So I would, and I will tell you why I would say so.
Yeah.
So as we discussed during the start of the interview, so when it comes to passive, I have to decide the index.
Right.
When it comes to active fund management, I need to decide the fund manager.
Correct.
So if I have to decide, I am the first time investor and I have to decide which passive fund should I go for.
Yep.
Then how should I choose the index and how should I decide?
So it's your temperament as an investor and your return expectation and your time horizon. These three factors come into play whether you're selecting an active fund or a passive fund. So those same considerations will be there. And once if like suppose you have an appetite for more risk, you have appetite for volatility, if the returns fall, you are not disturbed by it, then you can go down the market cap curve. You can go and buy a small cap 250 index for next 10 years. You will definitely generate some alpha over Nifty 50 because those are well discovered stories. The long term return for Nifty has been in the range of 12 to 14%. So if your return expectation is 12 to 14%, then you go with a large cap index. If your return expectation is that I want 15% return, 17% return, then you'll have to go down the market cap curve. So you can go to a mid cap 150 or a small cap 250, or you can go for a all cap index also, which is popular, Nifty 500, BSE 500. Those are also popular. And the other thing in passive which you look at over and above that is the expense ratio, the tracking error, the tracking difference, how closely is the fund matching the index returns. That is important when you decide to invest. And what is the running expense ratio? The expense ratio is lower, the more returns come to your side. So these are the factors one should look at. So I think if some investor has a return expectation which is lower and with lesser volatility, then they should consider the larger cap indexes. And if one is looking at more volatility and higher returns, then you go down the market cap curve. And if you are looking at, let's say, you're looking at factor based indexes and you feel that you want an alpha, you can choose a momentum strategy for next 5 years, and you can do an SIP in that, so that you will capture all the market points which are there and you can hopefully generate alpha over the Nifty 200 over that time. So that should be the thought process.
And probably the next level can be taking sector calls.
Yes, if you are comfortable, like suppose you read in the papers auto sector is doing well, it has picked up, then you can buy an auto index, which is very simple and it can pay off. So I mean, I'll tell you, the PSU index did very well. So you had CPSE index, you had the PSU bank index, which did very well in last 3 to 5 years because there was a re-rating, so as to say, for them. So anything which has fallen out of favor, which has not done well in current trend, maybe the consumer stocks have not done very well. So you can look at a consumer index which may be not doing well today, but when consumption picks up, it will do well. So yes, the factor based or thematic, even on the active side, thematic funds are very popular. But yes, you can take a call based on your view on a sector or a theme there very easily. So that is also possible.
So to summarize, we can say कि first take market cap call.
Yes.
And market cap, as you rightly said, go down the market cap curve. First go for large cap, then mid cap, then small cap.
Correct.
Once you get comfortable with this, then you can go for fancier or let's say more complex strategies like a
Yes.
smart beta,
Correct.
volatility kind of.
Right.
And then finally you can go for sector call.
Based calls. So if you're a mature investor, then you can take a sector based call, or let's say Nasdaq suppose fell 10-15%, and these are world class companies.
Tactical calls.
You can take a tactical call and then you can generate outsized return. So this has been demonstrated also. Like if you see in late 2022, early 2023, all the tech stocks had fallen, and then they went up 3-4 times. If someone wants to capture that in India, you can just buy the Nasdaq index then. So similarly, as I told you with PSU bank index, if they didn't do well for long, if you just went and bought a PSU bank index or a ETF, and that did very well, and so did auto in the last 1 year. It was the best performing index. So those are the more experienced investors who have seen market cycles and they want to back their instinct, and they feel that a particular sector or theme is going to play out, they can go for that.
So Sandeep, we are in the last segment of our discussion. So if you can tell us what is tracking error, what is information arbitrage, and any other term that you can think of which somebody who wants to invest into passive strategy should be aware of.
So tracking error is very simply the difference between the returns in the index and the return of the fund. In tracking error, if you are monitoring this on a daily level, so it takes into account, the concepts like impact cost, buying, selling in the fund. So that contributes to the tracking error. So it takes into account standard deviation also. So on a daily basis, tracking error is very relevant for someone who's coming in and out of the fund, like a trader, for example. And tracking difference is more relevant from an investor because that is the difference between the index return and the fund return on a point to point basis. So then you will know exactly अच्छा रिटर्न का इंडेक्स का रिटर्न 30% आया और मेरे फंड का रिटर्न 29.5% आया, तो 0.5% इज माई ट्रैकिंग डिफरेंस. दैट इज़ वेरी रेलिवेंट फॉर एन इन्वेस्टर. Besides this, in passive products, there are two type of products. One is index products and one is ETF. So index is just like any other mutual fund. You come and buy and sell from the
There is single
AMC.
price for buying and selling.
जी, और उसमें एग्जिट लोड भी नहीं होता है, एंट्री लोड भी नहीं होता है, तो आप NAV पे ही बाय और सेल कर रहे हो. इट इज़ वेरी सिंपल. तो फिर आप वो टोटल एक्सपेंस रेशियो देखोगे, दैट डिसाइड्स योर ट्रैकिंग एरर एंड ट्रैकिंग डिफरेंस एंड डिपेंडिंग ऑन द एफिशिएंसी ऑफ द फंड मैनेजर. ETF में क्या होता है, इट इज़ लाइक अ शेयर विच इज़ ट्रेडिंग ऑन द एक्सचेंज. Only people who have about 25 crores can come directly to me. Below that, they have to go to the exchange, even if they are ultra high net worth, HNI, whatever, even if there's a company. Only exception being the PFs and the market makers, which we appoint for our ETFs. They can come to us for one basket. Other people have to go to the exchange. So there you go to through your securities broker, whether it's Zerodha, HDFC SEC, ISEC. So through these brokers, you'll buy and sell on the exchange. So there will be bid offer, both quotes will be there just like for any shares. So there it is important to look at the liquidity and the impact cost. So impact cost is if you go to buy the ETF, are you paying 1 or 2% more premium than the live price? Then that is known as the impact cost. So if you're going to sell, you have to sell it at a discount to the live price. So that is also impact cost. So that is important. The trading volume which is there in the ETF, that is important. And there is a concept called live NAV or INAV, indicative NAV, which is an ETF, which you can see on the exchange or even on the respective websites of the issuer, which is the AMC, the mutual fund. And that will give you an idea what is the value of the moving price of the basket. Because in an ETF, you are buying a basket of stocks. No, you are not buying only one stock. So there's a moving price which goes up and down. So looking at that, you can put your quote so that you're as close to the market price as possible. So those factors come into play for a ETF, not for a index fund. And index fund, all the costs are borne by the mutual fund scheme only, which is part of the total expense ratio. In ETF, you'll have to pay brokerage, you'll have to pay stamp duty, which you do for a share, you'll have to pay some exchange turnover charges. Those are your costs. That's why the recurring cost for ETF is lower than index fund, because you are paying some upfront costs. So these are the factors. If you go to sites like indiapassives.com, which is a NSE site, you can look at all this data, you can look at the trading volumes. And index funds are more or less like normal mutual funds, where they are rated by value research and money control or Morningstar. If they are there for 3 years, they will start carrying those 3-star, 4-star, 5-star ratings, and they will give you more clarity on all these parameters which are there for the particular index. So of course you don't have factors like Sharpe ratio or something like which you have for active products, because here you are just getting the
Index
matching the
returns.
index, you're capturing beta, there's no alpha here. So the tracking error, tracking difference, and there are certain other ratios which you can look at, but then you are looking at more macro ratios for the market as a whole. So you look at the PE ratio for that particular index. Is it expensive? It is cheap. What is the 52-week high for that index? What is the 52-week low for the index? Let's say, the Sensex was at 85,000 or Nifty was at 26,000. Today they are 8-9% lower. So that gives you an idea that yes, I will get this index fund or this ETF also roughly that much lower. So that gives you a good entry point. And you have to see whether it is mirroring that trend. It should not be that the index has fallen 8-9%, but the fund has not fallen that much. That means it's not doing its job correctly. So these are all factors. You should see size, you should see liquidity. These things are important.
And what is the concept of information arbitrage?
So basically that is the information edge that you have, so which a professional investor has. So that is something by which they are able to create that alpha. So as more and more information becomes transparent, that information arbitrage starts disappearing. That is why then passive funds start becoming more popular, because the fund manager finds it difficult to generate that kind of alpha.
So Sandeep, when it comes to information arbitrage, is it only about the access to information, or it's also about ability to process that information?
It is a bit of both. Whether how to interpret that information, whether that is positive for the company, negative for the company. So that is more apparent in individual securities than
Yes.
for the market as a whole. So the thing is that a retail investor is not expected to have the same amount of maturity that a professional fund manager has. They are more dispassionate. They can take calls. If there is bad news, they will sell the stock immediately or cut down their exposure. If there is good news, they will double up on that stock, because they feel this is good for this part of the industry, and within that industry for this particular business that the company is running in. So a retail investor may not be able to grasp these concepts.
In fact, it's not only about retail. If you talk about even HNIs, ultra HNIs.
Yeah.
So
I mean to say any individual investors is a better way to put it than just retail or.
So we can say ki, a fund manager or a wealth
Correct.
manager also brings the value addition that he takes out the emotional part of investing
Yes.
from the process.
Yes.
So if I am investing my own money, I may be suffering from certain emotional biases
Yeah.
like confirmation bias, herd bias, etc.
Loss aversion.
Loss aversion.
There is a lot of uncertainty which is there in the decision making, and you may not even have the ability to book profit at the right time and take some money off the table. That advisor or wealth manager or a professional fund manager, they can do that. They feel that the story has played out, all the positives are in the price, and it's time to take some money off the table and rotate the story to another sector or another theme. That they can do. Then the individual investor feels that if that has played out well, that means it's amazing. So that confirmation bias is there. That prevents him from getting out of that particular theme or story.
In fact, I read about another concept recently, which is status quo kind of bias.
Right.
So what happens over there, if I am investing my money and I have to take decision, there is a higher propensity that I won't be able to take decision, because then if it goes wrong, then that can be tracked back to my decision.
Right.
So instead of taking the decision, I
take
may
no decision.
I take no decision.
But that also is a decision.
That also is a decision.
Not to take a decision.
Yeah.
So so I think human emotions are there, as there's behavioral science. There was that Nobel Prize winner Khan, who
Khan.
recently expired. So he had all these theories.
Think slow, think fast.
Yeah, and where all these biases that he came up with, how they influence the decision making behavior for an investor in the market. So that is very real, and to take the emotion out of your investment and being dispassionate about it comes with time. It's not something which you can do overnight. Only when you take a loss or you get some profit will you understand how these things work. And over time you have to as they say, develop that temperament for investments. So having a temperament and a good character is also equally important for success in the investment world, just like any other field.
So as they say,
life.
more than IQ, it's about EQ.
Yes. So IQ is important, but EQ is also very important. You have to be quite stable emotionally and not get carried away with the herd mentality, as they say. And there you have those manias, or you have those boom and bust
Cycles.
So Warren Buffett would say, be greedy when others are fearful, or be fearful when others are greedy. It is a very simple sentence, but it's very difficult to implement. And it takes years and years of buying and selling stocks, over time, over many years. That makes you then look at it very dispassionately. Yes, I have seen the story. I know it has played out. There is no more PE multiple expansion which can happen infinite times, and you can get out of the story. And when you know that there's a very high quality business which is going through a rough time, which is not permanent, it is temporary in nature, so you have an opportunity to buy it at a lower price, you do so at that time. So these things are some things which you can do only by doing, not by just as you said, that not taking action, or it becomes very difficult because people become emotionally attached to their investment.
Yes. So as we discussed during the start, nothing is permanent.
Yes.
So I got reminded of this matrix by Khan only, where he did this 2x2 matrix, which is very typical of MBAs. and the parameters was confidence level and level of actions.
Right.
Ki how impulsive you are, or how judgmental, or how calculative you are with the investment.
Correct.
So what he did, he made a matrix basis your level of action taking and impulsiveness, you can say.
Right.
And basis your level of confidence, and he distributed you in 4 categories. One was individualistic, the second was Gaussian, the third was impulsive, and fourth was celebrity.
Okay.
So he showed that basis these combinations you can land up in any segment,
Right.
and it's also that you may be belonging to different segments in different time frames.
Right.
So it's a very complex word. We try to justify it, explain it basis numbers, but at the end of the day, it's also about human psychology.
Yeah.
Thank you, Sandeep. Thanks for the discussion. Thanks for sharing so much knowledge.
Thank you, Ankit.
Thank you for coming.
Thank you for this opportunity. I hope this was a good session for
It
your
was.
viewers.
It was very knowledgeable. Good session.
Thank you so much.
Thank you, Sandeep.